Valens Research, Uniform Financial Analytics.
Disney, of course, actually just reported earnings today, or last night, I should say. And when they reported earnings, right, the earnings numbers highlighted the fact that people had expected them to lose money, and they actually made money. The really interesting thing is part of the reason people thought Disney was going to lose money is because people thought Disney lost money last year. Right? When you look at an as-reported basis metrics for Disney, and we don't even focus on return on assets, we just focused on EPS in terms of what did the market think EPS was for Disney last year. What we can see is the market thought that Disney actually had a negative $1.57 EPS last year. In reality, right, Disney didn't have negative $1.57 of EPS last year. It actually made $2.25 in terms of EPS. But as you can see here, it didn't go negative. It dropped, but it stayed positive, right? This company had $2.25 of earnings last year. It was still profitable even last year in the midst of the worst possible situation for the business. It hadn't fully ramped up streaming yet. It lost all sports from ESPN. It had to close all of its experience businesses in terms of theme parks and cruise lines. And yet this business was still profitable. No wonder this quarter, right, in Q1 or Q2, whatever it just reported, its earnings were positive again because it never was that bad in the first place. If you looked at the as-reported metrics for Disney, you would say there's no way this company could have been profitable in Q1 because they lost money last year and nothing has really improved. Because we were looking at the right uniform accounting metrics, we could recognize the reality, which is this company was already profitable in 2020, and therefore we knew in 2021 that was perfectly reasonable. And now you look at Disney here, and what you can see is a different conversation, right? Because Disney is a name that we actually think is really interesting. We can understand returns didn't drop as much as you think they did, and why returns are priced to rebound very quickly. We actually think that even with this expectation, Disney still looks interesting because of the combination of it basically putting a Netflix on top of its business. This company could see a lot of upside going forward because you're going to see returns recover to what they were in 2018, even if we didn't have the new business that it's launching in terms of Disney Plus and all of the other streaming things that it's doing. And with Disney Plus and the other streaming, returns are probably not going to get back to 19% levels. They're going to go even higher. These are the kind of really powerful insights we can see, but we can only see them if we use uniform accounting metrics to see through the noise and have the right conversation, do the right research, and have the right understanding of what profitability is.
Valens Research, the world's leading source for uniform financial analytics.